Good morning, everyone, and welcome to our webinar today about living ultimate beneficial ownership data. My name is Neil Isherwood. I'm a director of our subject matter expert and strategy group here at Dun & Bradstreet. And a big focus of mine, and indeed the group over the last 10 to 15 years, has been within our third-party risk and compliance line of business. We've been working on many projects with clients around AML, KYC, FATCA screening, various other regulatory themes. And of course, we've been heavily involved in beneficial ownership. And I'll just hand over to my colleague now, Martin, to introduce himself.
Thanks very much, Neil. So as mentioned, my name is Martin Skeens, and I'm a subject matter expert for our third-party risk and compliance solutions and tools. I've been working at Dun & Bradstreet for 10 years now, and my main areas of focus are beneficial ownership, hence this webinar, sanctions, screening in general, and third-party risk and compliance. I also am involved in a number of product design and teams that are looking at expanding of our data. So hopefully you'll find today's demonstration and webinar of use.
Excellent, thanks, Martin. So just before we get into the main material today, it's probably just worth level setting and reminding ourselves of exactly what we're talking about when we discuss beneficial ownership. So we'll use the Financial Action Task Force definition. And as you can see on the screen here, the beneficial owner refers to the natural person who ultimately owns or, importantly, controls a customer, or the natural person on whose behalf the transaction is being conducted. And also it includes those persons that exercise that control over another legal person or arrangement. So that's very much the standard we're looking to attain whenever we're trying to figure out who a beneficial owner is. So now we understand what we're looking to achieve. Let's quickly try and understand why it's actually very, very important. And there've been many, many news articles in the press over the last decade or so around money laundering scandals. We've seen the offshore leaks, etc. And they have given us a window into some of the bad actors and situations that anonymity can enable, from corruption, kleptocracy, tax evasion, money laundering, etc. But one of the more recent reports that's actually very useful and really highlights this is one that Europol released. So this paper covered the EU's most threatening criminal networks and how they operated. And it identified over 820 of those EU's largest criminal groups. And this report details how these criminal organizations can be very complex, and they often have hierarchical structures very similar to a normal business, and they even choose to outsource certain parts of their requirements, sometimes money laundering or even violence. So this basically shows the sophisticated nature, and it also introduces the use of crime as a service model, as law enforcement have been calling it. So where an organization needs some deep technical know-how, they will often liaise with other criminal gangs who often pick a specific area and niche and then provide their skills to other organizations. And a central theme to this is the use, or I probably should actually say more accurately, misuse of legal entities, i.e. business and their structures. And their agility can involve both the setting up of companies, or often they infiltrate existing ones. And the report states that 86% of criminal networks make use of legal business structures and entities. And these are really key to how they launder the money. The report also touches on the cross-border nature of it. So 76% of the organizations are active in multiple countries. And this is because they know that the administrative burden to follow transaction flows and links across jurisdictions is very difficult for law enforcement. And the gangs also rely heavily on corruption as well to evade capture. by intimidation, bribes, etc., to understand the threats of prosecution. And the criminal proceeds from these groups are often invested in various legal activities, such as real estate, even seen supermarkets and hotels. So making that distinction between legal and illegal income within the network, it makes it much harder to establish. The report also goes on to state that the #1 crime type currently is drug trafficking, but is very closely followed by fraud. And this seems to be at the moment primarily focused on investment scams, romance scams, etc. And that's because these frauds connect criminal gangs hundreds of millions in short periods of time. And it also then means they avoid the physical nature and risk of actually trafficking the drugs. So basically, we could see that the sophistication levels to launder this money have been significantly raised. We see trade-based money laundering networks that span the globe to hide the origins of that money. And in one of the case studies, it was quite interesting. South American cartels, they would provide drugs to Italian buyers, and they would in turn use brokers to introduce those proceeds into a network of companies. But rather than just try to take that money out, these companies would then fund the purchase of mobile phones from China. Those phones would then be shipped to the US, and then they would actually be shipped to Colombia and then sold in what is seemingly legitimate trade. So it's therefore generating very justifiable looking income for the cartels. So I think this report really shows the lengths these groups will go to hide the illegal origins of the money and make it really difficult to understand who is really behind these company structures. So that gives us a view into the scale and the complexity of the problem. And yet, even with that in mind, and those statistics from Europol, getting access to beneficial ownership information has recently been a bit of a roller coaster ride between transparency and privacy. This is something that was recognised in a compliance survey that we at Dun & Bradstreet carried out last year, where we questioned over 1,300 compliance decision makers across 9 countries. And one of the questions in that survey, 58% of respondents said it had become harder to access the data they needed for UBO assessment over the past couple of years. And in terms of the access to this data, we've seen numerous attempts to make transparency more key. And from a beneficial ownership perspective, on the slide here, we'll start at AMLD3, or to give it its long words, the EU Anti-Money Laundering Directive 3. And this was introduced in 2005. And this was very much the beginning, really, of where the actual phrase ultimate beneficial owner really started to become commonplace, and see it in a lot of the regulations around customer due diligence. And this directive brought in more robust customer checks. It introduced the concept of simplified and enhanced due diligence. And it also really spelled out explicitly the need to understand beneficial ownership. However, even with AMLD3 in place, the actual effectiveness of the system was limited, and many financial institutions and other organizations actually found it very difficult to get this information. And again, as mentioned before, we saw numerous cases of leaks, such as the Paradise Papers, Panama Papers, all manner of money laundering scandals throughout the European sector. So naturally, the authorities then looked at what could be done to tackle this and prevent it from happening in the future. And in a lot of those reports that did a bit of a post-mortem on what went wrong, that one of the major issues cited was the lack of access to beneficial ownership info. So in 2017, Europe introduced the 4th Money Laundering Directive, and this is where we saw that introduction of the requirement that every European jurisdiction had to create a centralized register of beneficial owners. and within which every company in that country must register and file those statements on their beneficial owners. And we also saw things like the introduction of where senior managers could be included within this definition if if you weren't able to actually identify who the UBOs were. But quite disappointingly, many European countries actually really dragged their feet in terms of actually adopting this directive. And many countries failed to introduce a register at all. And those countries that did actually put a register in place often had really onerous access restrictions placed on them. And in the majority of cases, they were usually only available to law enforcement agencies. So this meant that the true gatekeepers of the financial sector, so the banks and other financial institutions, they weren't easily able to access the information to help them when they were doing their onboarding and due diligence checks. So these barriers and difficulty in accessing this information meant the system response really was hampered and wasn't really effective. So then the EU then quickly followed up in 2018 with the fifth directive, and this then went further and mandated that all these registers must be available to the public. So that was their way of saying there should be no barriers whatsoever. Anyone that needed to understand who was truly behind a company should be able to get it. So from a Dun & Bradstreet point of view, and a lot of our clients, I think most of us thought that we'd pretty much got to the point of arrival in terms of effectiveness. But then in November 2022, the European Court of Justice made a ruling stating that public access to these registers was invalid. And this actually caused quite a large amount of those registers to just shut their portals down overnight. So just as financial institutions were really starting to utilize them, they were suddenly taken away. So then finally, we come on to where we are right now. In the May, sort of June time last year, the sixth money laundering directive was introduced. And this was actually quite a big package of changes. It introduced new regulations, a new European regulatory authority, AMLA, as well as an updated sixth money laundering directive. And this aimed to seek more of a balance of access to information. So within that, they recognized that completely open public access was not really achievable, but they were specific to call out that anyone with a legitimate interest should be able to access it. And right now, that directive is in the midst of transposition. So the authorities and register functions in each market are looking to implement these new rules. And the deadline for that is around about mid next year. So what does this new world look like now in practice? Well, I've got to credit Transparency International. They've been doing a fantastic job of tracking the status of these registers throughout this rollercoaster ride. And they've produced maps such as the one on screen here. And they've been detailing which countries have introduced a register, what stage it's at, and how easy it is to get access to it. And they made requests to a number of these registers using that legitimate interest mechanism. And as you can see on the right-hand side of the screen here, the responses have been very, very mixed. We can see that some countries, such as Sweden and Ireland, were very timely, very good, just taking a day or so to process that request. Then we've got some others like Belgium, France, Austria, taking somewhere between 1 to 4 weeks or so, working weeks to respond. Then we've got Hungary taking a very long time, 4 months. And apparently, according to Transparency International's latest article, Germany still hasn't actually responded to their inquiry. So once again, even though we have a directive looking to make access to this information easier, the reality is often very different and very varied across the regions. And also the distributed nature of these registers just makes it logistically very hard for due diligence teams to operate effectively. because naturally each country's register website is in its own language, its native language. These registers don't have a standardized data format. So some registers have a coding system. Some actually allow you to just put free text description of how someone exercises control. And the access mechanisms often require different credentials, different account logins to actually get in. And some of those restrictions means you actually have to need to be a national of that particular country to be able to get into the register. So from a day-to-day perspective of a due diligence analyst, if you are working across countries, it can be very time-consuming and really frustrating to obtain the information that you need. But rather than rely on Transparency International's view, we'd like to run a poll now for all you on the webinar and see how you are personally finding the access to the information. So hopefully a poll should pop up on your screen any second. There we go. And the scale here is 0 to 5, with 0 being it's very easy to obtain what you need, through to 5 being the most difficult and really hard to obtain what you have to get. Okay. So as expected on a UBO webinar, I think we're seeing obviously quite a bias towards the difficult end of the scale, with just a handful of people, I think from what I can see, saying that it's easy for them to get the information. So I would say that the poll very much represents what we're seeing through discussions with our clients, tending towards the harder end of the scale. So thanks very much for voting on that. Okay, so now what I'm going to do is look at this from a different lens. So obviously, up until now, we've naturally been focused on our side of things, in that we're often starting with a company and that we're dealing with, whether it's a client or supplier. But now let's just look on the other side of the fence for a second. And on screen here, we've got a small portion of the corporate structure of a German food manufacturer. And this group has over 280 entities within it, spanning 39 countries. And this corporate group is still privately owned. So right at the top there in Germany, we get to individuals. And if we concentrate just on Europe, then this group has 224 subsidiaries spanning 24 different European countries. So if there's a change in ownership at the top entity here, then this actually results in quite a large burden in terms of now altering the filings for all those 224 entities across 24 separate UBO registers. So it's quite a lot of updates that the administrative side of the group needs to implement. And of course, some of these subsidiaries could be in companies that feel managerial wise quite far removed from the HQ in Germany. Lots of these subsidiaries could have been bought through acquisitions. So often they may not be talking to the HQ company on a day-to-day basis. So you could see how easy it could be for mistakes to happen or things to get missed, and therefore how the information could become out of sync. And this is an inherent problem to any system where data silos exist. It's not just unique to these UBO registers. Anyone that works in a large corporation with different databases in different units, and you'll know that if they're not connected or there's not a single source of truth, then very quickly data can start to become out of sync, inaccurate, etc. And I'm now going to hand over to Martin, who's going to further look at the complexity in this area.
Thank you very much, Neil. So building on from Neil's example, we have drawn out 4 levels of complexity to define this problem further. On this page, you can see these 4 levels of ownership starting at the top, with the simplest type of ownership moving to the most complex type of ownership at the bottom of the slide. So starting with the first example, you can see that we have direct ownership. This is where the company is directly owned by one or more shareholders, and there's no intermediaries between the target entity and the beneficial owners. This is the simplest of the examples, and there's no further onward ownership chains. We then move to the second example, which is indirect ownership. In these cases, beneficial ownership would be through one or more ownership chains. So there would be multiple intermediary companies between the target organization and the beneficial owners. This leads to added complexity, as you'd need to access and investigate each of the shareholder filings for each of these organizations that form part of the ownership chain. The third level of complexity is multi-level indirect ownership. And this is an evolution of the indirect ownership, but where these ownership chains diverge and separate to either one or multiple shareholders. To add to this complexity, those organizations that form part of the chain could be on multiple foreign registries, and the registries may have barriers to access, such as fees and forms to complete the access to those shareholder filings. And those documents could also be in different languages and formats and layouts. So ownership chains, which potentially also flow through multiple jurisdictions, this adds complexity, time, and effort in terms of investigation and various different due diligence activities. Then we move on to our final example for complex and concealed ownership. In these cases, there may be multiple direct and indirect ownership chains, where these ownership chains may diverge and may converge again at multiple different points. This creates the most complex and time-consuming form of ownership to analyze and evaluate. Often these forms of ownership may also conceal ownership, as by its very nature, it may be difficult to cluster and to understand the total combined ownership percentages and levels of control. There may also be shareholdings based in territories with limited reporting requirements or publicly available data. The entities themselves may also be registered as trusts or funds or foundations, etc., all of which may conceal the ownership to some degree. So what is the answer? All of this may be overwhelming, but all of this is not doom and gloom. There are solutions and data that can be used to help you and your teams to pull all of the ownership data that you need for your due diligence purposes quickly and effectively and efficiently in a simplified manner that's easy to make sense of. So by multi-sourcing accurate, up-to-date, and truly global data, you can both improve efficiency and also get a better picture of the total risk and exposure that you may have through these complex ownership chains. At Dun & Bradstreet, we have just that. We have created a control and ownership database that multi-sources shareholding data, principal or director data, and beneficial ownership registry data to give you that combined and complete view of these companies and ultimately those beneficial owners that you are doing business with. You can see from the slide that we have some truly impressive numbers that showcase the large combined database that we have created. We have over 400 million shareholders, close on 400 million directors and principals on top of that. And then we've also included UBO and controller registries, which hold over 28 million records. We are then able to cluster all of this together in a giant graph database to give our customers a complete and instantly accessible view of their ownership risks. These ownership chains don't need to be built out one by the user. These ownership chains are instantaneously available and curated by Dun Bradstreet. Dun Bradstreet has these clusters on individuals that have multiple shareholdings or control across the ownership chain. So you and your teams don't need to spend time and effort trying to cluster individuals yourself. This data is essentially available at a click of a button. So what does multi-sourcing data enable? We've taken two particular benefits that we would like to highlight. The first of which is automation. And from the previous slide, you would have seen that one of the benefits of multi-sourcing data is that Dun Bradstreet is able to enrich the data compared to merely using single source data as a reference. And automated decisioning making tools love enriched data. The more complete the data is, the more likely it is to be automated in terms of decision-making rules. In this process, using such data will also lead to more accurate decisions and a wider picture of those that you're considering doing business with. The next point is efficiency. So by multi-sourcing, it creates efficiency that helps you and your team reduce the amount of time and effort involved in collecting and combining this data in a meaningful way to understand the total level of ownership risk. So considering all of this new insight, which we've just highlighted over the past few slides, we can now combine this with our view of that level of complexity that we discussed earlier. So by harnessing multi-source data in your due diligence process, it will allow you to increase efficiency across the board, but particularly so with regards to the top 3 levels of complexity. By doing so, you'll be able to shift the team's time and effort, reducing the time to review those more simplified cases and concentrate on your more complex ownership structures. More complex ownership structures have added risk and therefore require more attention. For example, these cases may require extra investigations and even potentially reaching out to the clients for additional information. And I'd be remiss if I did not at least touch upon where this activity sits within the wider automated KYC onboarding process. As you can see, identifying beneficial owners sits within this chart in the middle, and it helps aids the end-to-end automated process. It will feed into sanctions and compliance risks, and leading ultimately to better decision making and more efficiencies later in that process. So I'm now going to go through a number of examples. On the slide, you can see, and on the next few slides, we provide a few examples which will illustrate and bring to life the levels of complexity shown previously. All of these examples are real organizations and individuals which we have anonymized and will touch upon the various different levels of risks. So it's a little bit blurry on the screen, but essentially what we had showcased here is a snapshot from our risk analytics solution, and it showcases not only the ownership risk, but other levels of risk. So if we just skip through that and move straight to the actual ownership view itself, in this particular example, you can see a company that has a fairly simplified ownership and control structure, using only direct ownership. In this example, the target entity is a British company, and as you can see, it has the Union Jack flag just above it. And this entity is called, in this case, we've anonymized it to Anonymous Limited. And you can see that that's shown in pink in the middle of the diagram. For reference, all the individuals in this diagram are represented by groups of people, and all the organizations are represented by a building icon. You will also notice that we have linked 5 direct shareholders holding 20% equity and voting shares to the target entity. And you'll see that the 3 shareholders shown on the right of the diagram are also directors of the target entity. All of the data that you see combined showcases Dun Bradstreet's approach to multi-sourcing our control and ownership data. All of the data on the target company can be pulled instantaneously and represented in such a graph. And as you can see, this is a fairly simplified view of ownership, which may take a short amount of time to analyze. So let's move on to maybe a more complex example. So in this next example, we will showcase multi-level indirect ownership. In this case, we have a target entity, which we've named Fictional Limited. It's also a British company, and is shown to the left of this diagram in the pink circle with the Union Jack just above it. Again, for reference, all the individuals in this diagram are represented as people icons, and all the organizations are represented by building icons. So you should notice that in this particular example, the target company is directly owned by a foreign company, and the ownership chains continue through a number of foreign companies, ultimately leading to the individual in the middle of the diagram, Bjorn Borger, holding the majority of the indirect ownership of Fictional Limited. This showcases not only that Dun Bradstreet's ability to multi-source data from the UK, but also registries and territories across the globe. You can see by the Danish flags representing the Danish companies in these particular ownership chains. You can also notice that in this particular example, that the target entity Fictional Limited has reported that its only personal significant control, that being a PSC on the UBO registry, is a direct shareholding company, which is below on the diagram, rather than it being Bjorn Borger in the center of the diagram, who ultimately owns 75% of the target entity. So if you were investigating this target British company and solely relied on the PSC filings at Companies House, you may not have known about Bjorn Borger ultimately owning that large proportion of the company. To ascertain the ownership percentage controlled by Bjorn Borger, you would have needed to access the individual shareholder filings and investigate these for each of the entities along this chain. This can be a fairly time-consuming and onerous process. So you may also notice that Bjorn Borger is a director of Fictional Limited, but that is not, if that was not the case, and you were not aware that he was an indirect shareholder of the target entity, then you may not have included him as part of your screening process, ultimately leading to potential other risks further in your due diligence process. To remove some of this burden of review, you may wish to also remove ownership under a certain percentage threshold. This is easily done dynamically in our control and ownership graphs with Dun Bradstreet's risk analytics platform. Here you can see that by setting the beneficial ownership percentage threshold to 15%, and above, that Bente Berger, who had 10% of the ownership, was removed. You can also run a number of additional filters. I don't have time to go through all of these today, but a filter that might be of interest to many on the call would be the ability to both see and count and highlight in the diagram all state-owned entities. And they also might be interested in looking at publicly traded companies within the ownership structure, particularly when these are quite complex ownership chains. For some due diligence programs which are following a risk approach, a stock-listed entity may lead to the company being investigated and undergoing a light touch review rather than a full set of enhanced due diligence. While on the other hand, those organizations that are being reviewed, which are deemed to be state-owned, may wish to conduct a set of enhanced due diligence to meet their anti-bribery and corruption obligations. So this example has clearly shown that there's an increase in complexity, but if you have up-to-date, accurate, and truly global data that is linked using multi-sources, like what Dun Bradstreet can offer, then this will allow you to find efficiencies and remove such entities and allow you to concentrate on more complex ownership and control structures. And with that, we'll move to my final example, which showcases a truly complex ownership structure. You can see from this example, it almost looks like a fireworks display and contains many organizations and individual nodes that are linked together. I just want to remind those on the call that that these are real examples that we have anonymized. So this is something that you could see in your due diligence process. If we just move to and zoom into the top left of the graph, you'll see that we have the target entity, which we have called Imaginary Limited. This is shown to the left in the pink circle, and the ownership of this company is transferred via a number of ownership chains to Alpha Holdco Limited. Each of these ownership chains has 100% of the voting and equity shares, therefore fairly simple in nature, but time-consuming to analyze if done manually, as you would need to review the shareholder filings for each of those companies individually. Following on from Alpha Holdco Limited, you can see that the ownership expands out in a number of different directions. And if we look at a few cases individually, you will notice that in this example, Beta Capital Partners LLP, that is listed as a limited liability partnership, would be shown on this particular chart, but it wouldn't have any shares by its very nature, being LLP. Therefore, we have not displayed the shareholders for this particular organization. However, LLPs do still report PSC, so personal significant control, as this is demonstrated in this particular graph. You can see those listed just off of that. Now we move to the bottom right-hand side. Dun Bradstreet has also spent a lot of money procuring data on companies registered in the Crown dependencies, and you will have noticed that this has helped in identifying Gamma Jersey Limited in this particular example. You'll also notice that Dun Bradstreet will separate out shareholders that have equity and voting rights, as well as those that purely just have equity shareholdings without any voting rights. There are a number of these cases in this particular diagram that we can see in this example where there is those differences. Now we'll move to the bottom of this diagram, which showcases that there are a large number of PSCs which are linked with the same 4 companies. Each one of these lines represents a document which is filed at registry. So by pulling this information manually, it could take a lot of time and effort. But by utilizing our data, we're able to combine all of this and represent this in our tools in this easy to understand diagram, so that you can see that all of those individuals are linked to those 4 individual companies through their ownership. With that, I'll hand back to Neil, who will talk about always on UBO monitoring.
Excellent. Thanks, Martin. So I think some of those examples there have given us a really good overview of real life cases of, like Martin said, some simple ones, some medium ones, and some quite complex ones. And it kind of shows, really brings to life the automation of how quickly we can produce those. But one thing we should definitely keep in mind is that this information needs to be kept up to date. And this is made much easier when you take a data-led approach, because the automation and efficiency that Martin's shown there means it's achievable to do this. And many clients may only revisit ownership on a maybe 1, 3, 5 year time frame, usually with a periodic review. And obviously a lot can happen in those timeframes, especially the longer ones like 5 years, that can really expose you to risk. And this was something that was especially evident after the Russian invasion of Ukraine. And there was obviously a deluge of additional sanctions. So many firms knew that they were screening the names they had on a daily basis, and they knew that their screening providers were updating the lists. But then they started to question, were they even the right names? So we actually had to run a huge amount of UBO remediation exercises, as many clients of ours knew that the data really hadn't been touched for many years. So again, because this data exists on file for D&B, we can do that pretty quickly on large volumes of cases. So again, back to looking at UBO in the wider context of a compliance program, there needs to be a feedback loop to ensure that everything is kept fresh and the data is living, essentially. And just to illustrate this, the slide here shows the amount of change in some of the underlying data. So these statistics represent 1 month's worth of changes across the entire UK business universe. And you can see that in terms of direct changes, these naturally have a higher tendency to be more material because they're not diluted through various links in the chain, as Martin has shown in those diagrams. And these account for about 1/3 of the changes. When we then move into indirect changes that could be 1, 2, 10, 20 companies away, obviously they start to be less material, with 92% being under the 25% threshold and 8% being above it. And even though the bulk of these changes can be minor, there's still a reasonable amount of them that are significant changes in ownership. And these changes, as Martin has shown, going through multiple levels, these are ones that often are the hardest to keep track of due to the distance away from the entity that you're dealing with. So now we're just going to run one final poll. This is the last one. And we want to ask you to let us know how often you check for changes in the ownership structure. With the options being you do it continuously, you're effectively live with event-based reviews. Is it monthly, quarterly, every 6 months, annually, or longer than that? Maybe it's 24 months or longer, or perhaps you don't know. If we're able to push that poll out. So we'll give you a little bit more time just to vote on that. I think this will be an interesting question. Just from our conversations, I think a lot of clients we've spoken to said it's so difficult to get the ownership that maintaining it is something they don't often want to revisit for quite a while. So it'd be really interesting to see what the results are on this one. And if we're able to maybe close that poll now and take a look at the results. Okay. Well, I have to say, I'm actually quite surprised at the amount that have put themselves into the continuous live monitoring. That's great to hear. Obviously, there's a number of people on this call doing really, really well. Then we're seeing about 30% or so on an annual basis, adding to that a few further. So I guess this represents the shift that we've been seeing from periodic review, and a lot of our clients are very much striving towards a perpetual KYC type program. I guess now that we're a number of years into that concept, that we've now got a lot more in the continuous live monitoring section than we would have seen if we'd have run this poll maybe a year or so ago. So well done to the 32% that are in that bracket. Okay, so we're pretty much at the end of the webinar now. So we'll try to wrap up and condense some of the key takeaways. And I would basically sum these up as efficiency, automation, and time. So efficiency, try to break the problem down into more manageable pieces and situations where the process of collecting the information can be done quickly and without manual effort and input, just like Martin has shown in his examples. And then in terms of automation, I'd say don't forget the wider lens and understand where UBO sits within a wider CDD process and look to link it seamlessly. That way, the output from the efficient retrieval of ownership and control can often be immediately fed into other downstream processes, such as screening for sanctions, PETs, adverse media, etc. And then finally, time. I would say this is often the commodity that is the most scarce in compliance departments that we interact with. So if you achieve the efficiency and automation, then as mentioned earlier in the presentation, it frees up time that can then be spent in those areas of highest risk or concern. So obviously it gives the teams the bandwidth to investigate and dig into those examples that are trickier, or perhaps the ones that just don't smell right, that have got some of the concealed ownership in there, ones that really do feel further checks are needed. And it's very much that last portion that Martin outlined, the trickier ones, that you typically have the largest gains in terms of risk mitigation. Okay, so that's the end of the material. I hope you found it interesting and useful. And we do have some time for Q&A. So please feel free to put any questions you may have, and we'll try to get through as many as possible. And I'll take a look into the ones we've received so far. So quite a few, actually. I think what I'll do is I'll try and tick off some of the more simple ones. So someone's asked, what does the has principle mean in the diagrams? That's quite a quick one. So that effectively is a director or management role from D&B. So as Martin said, when we source these documents, often a director is registered with one filing. They might be the same director, they're registered with a shareholding filing. In terms of a lot of the registers, they're separated. It's Dun & Bradstreet that pulls those together. So effectively, the has principle means that where that line goes, they're a director or manager of that company. So that's a reasonably quick one. Let me see what else is in there. Will you be sending out the recording? I think that's a yes. I think hopefully our team have talked about that.
We had another one about principals. So principals in our diagrams is represented by directors. So where there is a director, that's what we are meaning. So it's interchangeable with directorship.
Yeah, I see that question. And actually, just to note that when we display a diagram, the principals and directors of the other companies are filtered out by default. So our standard filter is the immediate principals, but you can actually include every director that we see in the graph, but that does make it a lot more complicated. So, yeah.
There was another one about how fast is expected for a change to be represented in our control and ownership database. So as soon as that change is reflected at the registry with one of the filings, that data is instantaneously taken into the tool and merged with that large graph database that I was alluding to earlier.
Yep, thanks, Martin. There's a question here that says, what are the main challenges the EU faces in making UBO registers fully interoperable and up to date, especially after the ECJ ruling limiting public access? Very good question. I think that they're going to face a lot of challenges. The part of the directives did talk about a combined system. I think it was nicknamed Boris, Beneficial Ownership Registry Interconnected System. I think that from what we've seen, Boris and that centralized view still feels a long way off, to be totally honest. From the material we've seen, which is quite scarce, it feels like the first stage of Boris is just going to be a centralized portal that effectively links you to the individual country registers. So from what we've seen, it's more like a jumping off point that you can go to one place. It doesn't look like it's tackling the true centralization of all that data into one data source. So I think that's a challenge further down the road for the EU. From the discussions we've had at the Commission and the Parliament, getting the registers up and running is their first hurdle. And I think in the news recently, they've issued infringement proceedings already on a number of member states in terms of getting those registers set up. So it seems like they want to be quite strict. They're pushing each country to get their register live. I guess my personal view is it'll take a longer time for then the efficiency aspect and centralization to come in.
We've had a number of questions about the new BIS 50 ruling, or the affiliates rule. I think with that, I think this highlights the benefits of multi-sourcing shareholder data. As many on the call know, that the shareholding doesn't necessarily dilute. It's almost like a waterfall effect where that shareholding has been identified as being one of those listed on the BIS lists. And if you were just purely basing this on PSC data, so the UBO registries, they won't be filtered down to those with lower percentages. Many of these are set to a minimum of 25%. So if you had a number of individuals on those BIS lists, maybe 5 or 6 that have 10%, you would have potentially missed those as part of the screening. So using the multi-source approach, looking at providers who have, like Dun Bradstreet, that have the ability to pull data at any percentage, that will allow you to then adhere to the BIS 50 ruling.
Thanks, Martin. And there's 2 questions that I think are very similar, so I'll just try and condense them into one. So the first question says, how do you deal with challenges where data logs and regulations are opaque, geographic locations where information is difficult to obtain with language, etc. And then there's another question similar. We find that some jurisdictions much harder to locate UBO information. Is this dependent on how much is readily available? And are we hopeful this will continue to improve? So I'll maybe try and tackle those both in one. You're absolutely correct. There are some countries and jurisdictions that are well known for not exactly being transparent. A lot of the overseas territories of the UK are listed in those. We know that the UK government has been heavily leaning on those markets to put registers in place. And I think I recall reading in the press a few weeks ago that they've missed those deadlines, sadly. And you're absolutely correct that the second question, obviously, the information available is dependent on each country and their filing regulations. So that's why we want to wrap in these beneficial ownership registers, because, yeah, if the shareholdings end up in one of these jurisdictions, then we will effectively have a break in the chain. But if the starting point is within Europe or a region that has put a register in place, then hopefully the premise is that would jump to the end point, so we'd be able to see it. But you're correct, it's not straightforward in every case. In terms of other countries, I think we see a generalized trend to things getting better. Canada, for example, has pushed a register out to the public. I think Australia's committed to having one. I can't remember now if they are starting the program in 2027 or if they plan to have it. So those are plus. But on the flip side, we have slightly negative jurisdictions, such as the US, where the Department of Justice said that they wouldn't enforce the filing of UBO information to the FinCEN UBO register. So maybe that's a slightly negative step backwards. I think generally our view is things are creeping forward, but it's not plain sailing. But really, just to reiterate what Martin said, what we're aiming to do to help with these scenarios is tackle the situations where you can get them done quite easily, and the vast majority of companies are small, medium enterprises, and the chances of getting good information are actually quite good. So I think there are always going to be tricky ones, basically, where you're going to need to save some time to maybe go out and do some additional research.
I think that's covered up a huge group of those questions there. Just trying to see if there's any others in the chat.
There's one that I'll just tag that says, do you cover UBOs also from exotic countries? I'll maybe just reiterate that previous answer is we do have registry feeds from a lot of exotic countries, but it does depend on the filing regulations. If the data isn't public, then it's a challenge for everyone. If the starting point is outside an exotic country and goes through it, then very much trying the other source, i.e. the UBO register, is often the way we would go through that. There's quite a few questions, actually. Then there's another question here. I guess the existence of bearer shares in a company could induce some doubt about who owns what. Yes, very good question. But based on the FATF principles, a lot of countries have basically worked to eradicate bearer shares. So I think they're becoming a lot less common, and those countries that do allow them often have now introduced the concept of having to be registered, that bearer shares have to be registered. I think Switzerland has worked very hard to eliminate bearer shares from its registry filings. So I think our perception of that is that the presence of bearer shares and their impact has become a lot more minimal from what we've seen. Okay, is there any more questions you've seen, Martin, that I have?
No, that covers a large number of them.
Okay, we are 1 minute to time. There is another question saying there are some legitimate large businesses owned by families who are private and prefer to keep their personal information confidential, etc., etc. How do you morally feel about these families who may use complex structures to avoid registering their own details? I'm not sure I can comment on the morality, to be honest. I think that the way I personally look at this is being from the UK, I probably take a UK-centric view, but very much the ethos of businesses and legal entities in UK company law, it's very much been described that transparency is the price you pay. So there are obviously a lot of advantages of using limited liability companies. There are obviously protections from the debts and problems, and very much in the UK at least, it's very much seen as if you want to use legal structures, if you want to take advantage of the ability to kind of move assets and push profits through a certain jurisdiction or structure it, then very much the UK sees that transparency is the price you have to pay. I'm not sure if that is a sentiment echoed in every country, but I think that would be my personal take on it. Okay.
One quick one, just for a minute, talking about language challenges. So one thing that Dun Bradstreet works on is translating and transliterating various different filings from across the globe and standardizing those so that they can be easily ingested in your automation process. And often we'll have the original text for some of those elements as well. So we do try our best to make sure that there's that standard approach so that your systems are able to utilize it, but still keeping that original data.
Excellent. Thanks, Martin. I'm conscious that we are now 2 minutes over, so apologies for that. There's really good set of questions in there. I think we got through most of them. If we didn't and we're able to see who raised the question, then we'll perhaps try to answer it via email if we have the contact details. And just quickly before we go, we do have more upcoming webinars. The next one is the 6th of November. And of course, if you have any questions, any queries, want to understand our capabilities further, then obviously please don't hesitate to reach out either via the website, LinkedIn, or via any other means. So once again, just like to say thank you for joining the webinar. Thanks for giving us your time. And yeah, we hope to maybe see you on a future event soon. Thank you.